Hi, good evening. We welcome everyone. Sorry for the trouble. I think earlier meeting link was having some issue, so we could not join there. So I think we have shared all the participants a reverse link. I think let's wait for a few more minutes. Maybe we'll start at 5:10 so that everyone can join. I think still participants are joining. So let's wait 2 more minutes. Okay, so we can start. So I thank you everyone for joining the webinar. So, let's not waste time. Let's go to the topic. So I'll just share my screen. Just confirm if you can see my screen. Is my audio video are clear? Are you able to hear what I'm saying? Animation slideshow. Yeah. Can someone put in the chat box whether my audio is clear? Okay. So we're going to discuss about foreign trade policy 2023. See, this topic is very relevant now. As you know that in the month of January 2020, Mr. Donald J. Trump became president of the United States of America, and from his first day of his office, is uh, he has started threatening to the world countries that he will levy tariffs on the U.S. imports. So so this is a very important topic and very interesting also. So let's just jump into the topic. So before going into the topic, let's understand what is FTP, what is foreign trade policy, what is the background, how it has evolved over the time. Okay, so this has a small background. Let's go back to the year 1991, where the India has faced the severe global crisis, due to severe, I mean, the stringent trade restrictions, and also the government has not allowed any foreign investments to do the business in India. So due to that, and also back then the India was used to rely on majority of the imports. Okay, due to this reason, many of our foreign reserves got depleted, and rupee value got decreased substantially. Due to this severe global economic crisis has come in the year 1991. So then the government of India has implemented a scheme called liberalization scheme and globalization, where the government opened the doors to the foreign direct investments, and they have removed all trade barriers, and they have implemented free trade policies. Okay, so as part of a liberalization scheme, the government has introduced Foreign Trade Development and Regulation Act 1992. So under this act, as per Section 3 and Section 5, Section 3 and Section 5 of Foreign Trade Development Act, enables the government to issue a policy which we call as import-export policy or foreign trade policy. The government has power to implement a policy where the government will issue set of rules and procedures where the business can do easy of doing business, easy of cross-border trade. Okay, so in the year 1992, the government has issued the first import-export policy. Back then, it was called as EXIM policy. EXIM policy 1992 to 1997. Usually, this EXIM policy will have a lifetime of 5 years. So every 5 years, the government will review the earlier EXIM policies, and they will revise the policies wherever the changes are required. So after the first exam policy, they announced a second exam policy in the year 1997 that was valid up to 2002, and then third exam policy was introduced in 2004 up to 2009. This is the year where the government has changed the wordings of exam policy to foreign trade policy. After this, another foreign trade policy was issued in the year 2009, valid up to 2014. After 2014, the new foreign trade policy 2015 to 20 has been issued. And in the year 2020, COVID has come. Because of that, they have extended this foreign trade policy up to year 2023 with few exceptions, where they have stopped MEAS, Merchandise Export India Scheme, and SES, Service Export India Scheme. So after foreign trade policy 15 to 20, they have issued a new foreign trade policy called FTP 2023. If you see, earlier policies are framed for each every 5 years. Okay, but in the year 2023, they have issued a foreign trade policy 2023, which is a fixed policy. Okay, so going forward, the government is not going to make any new policies. They will only amend to the existing policy of FTP 2023. So this foreign trade policy will be governed by the Director General of Foreign Trade. We also call as DGFT. Okay, it's an agency under Ministry of Commerce and Industry. So we are discussing about foreign trade policy, right? So what are the objective of the foreign trade policy? So the primary objective for which the policy has been introduced is to regulate import and augment exports. Okay, the primary objective is to promote exports. Why government wants to promote exports? As you already know that when you promote exports, the government will get foreign exchange. When the foreign exchange reserves are increased, there was less demand for forex, and obviously the value of the INR will get strong. Rupee value gets strong. So the government always wants to promote exports and regulate imports. The government also wants to regulate imports. If you see, not every country is self-sufficient. you take any country for that matter, every country has to rely on other countries for some of the goods. Okay, so let's take an example that other countries are importing electric items, electronic items from China, and also food products from India. So at the same time, when we import goods from other countries, the government also doesn't want to import the crucial items from other countries, such as food items, agriculture items. If you allow import of agriculture items from other countries, okay, it will severely impact the domestic farmers, the farmers within India. So the government, along with promoting exports, it also wants to control the imports so that it will not make any injury to the domestic industries. Second, it also facilitates, encourages, and improve foreign trade relations across the countries. Okay, so due to this foreign trade policy, the relationship between the countries also will get developed, which is not happening in the outside as of now because of U.S. president, which has who announced tariffs for all the countries across the world, but few, I mean, the last week they have, even though they have proposed several tariffs on the Liberation Day, what they call as Liberation Day. Many of the, I mean, all the countries after Liberation Day, all the countries have approached US government, and then US has passed all the import tariffs except on China. As on today, the only country that has faced tariffs is China, which is around at 245% on imports. It's basically a trade war is happening between China and US. And next, so make exporters more competitive in the global market. It also allows the domestic exporters to export the goods at a competitive price when the government is issuing incentives and rebates on the domestic manufacturing. And it also enhances the industrial growth and job creation. When you open the doors to the foreign direct investments, okay, so obviously the industries will grow, and also the new technology will come into India, and obviously it will lead to the jobs creation. So these are the objectives of foreign trade policy. So what is the overview of foreign trade policy? So what are the topics that are under foreign trade policy? There are basically 5 categories under FTP. The first one, duty exemption schemes. The government has given few exemption schemes where the duty on imports are exempted. Let's say the scheme of EPCG, export promotion capital goods, where you can import capital goods without paying any customs duties. And also under advance authorization and duty-free import authorization, you can import raw materials without paying any customs duties. Customs duties includes IGST and compensation cess. So this is about duty exemption scheme, and there is another scheme called duty remission scheme. Under remission scheme, first you will have to pay the duty, and then the government will give you as a refund. The duty which you paid will be given as a refund. The first one is duty drawback scheme. This duty drawback scheme, what the customs duty which you paid on the imports will be given back as a refund in the form of a percentage on the export value. And road tab, remission of duties and taxes on export product. And also ROSCTL, rebate on state and central taxes and levies, which is basically applicable on textile products. So this is about remission schemes. And another scheme is EOU STP, software technology parks, and electronic hardware technology park, biotechnology parks. So under these are the ad hoc exemptions, where the exemptions will be given based on a status. Okay, if you want to get exemptions on the imports, you have to get a status of EOU STP and HTPS. So next one, DEH, develop districts as export hub. This and e-commerce exports. These two concepts are newly introduced under new foreign trade policy 2023, where the government is trying to identify the products under each district, the key products in each district, and the government turn in each district into an export hub. And also the government trying to improve exports through e-commerce operators. Let's say if you take an example of China, where exports through e-commerce itself crosses $3.5 trillion in the year 2024. So the government has realized the potential exports through e-commerce, and then they have introduced this new chapter in foreign trade policy. So last and final one, it also regulates import and exports. Uh, so as I already told that the government also wants to regulate imports. Uh, the classic example for this agriculture product, and also in case of exports also the government wants to regulate in few scenarios. Let's say, in the last year 2024, I think you might have heard in US there was a shortage of rice. Okay, so then the Indian companies have started exporting it to the US. Then immediately the government has identified this and put a restriction that we also call as quantitative restrictions. The quantitative restrictions are two types. One is quota restrictions and also the licensing restrictions. Quota in the sense, you can the government will say the exports in the year 2024 can only be made up to 100 tons. So this is a quantitative restrictions. So the government has imposed restrictions on export of rice. So these are the restrictions are necessary to to protect the domestic consumption. Okay. So this is about the foreign trade policy, and so out of these topics today we are going to discuss only about export promotion capital goods (EPCG), under which you can import capital goods, capital assets without paying any customs duties. So what are the topics we are going to cover while discussing this topic EPCG is first one, the chapter 5 of foreign trade policy and chapter 5 of handbook of procedures. If you see GST Act, how GST Act and GST rules are available, so under FTP also foreign trade policy along with handbook of procedures are there. Okay, so basically foreign trade policy gives you about the policy, how the imports can be made, how the exports, whether this product can be exported or imported under which license, whether the customs duties are exempted. So it basically talks about the policy, but handbook of procedures is name itself suggests that it's only basically talks about the procedure. So when the policy says that the particular product can be imported, and the procedure will say how it can be imported. So it's basically the procedure. So next one, appendices and ayat niyat forms, ANF forms. So these are ANF forms are the applications forms. Let's say if you are going to apply an EPCG, you have to make an application in form ANF. Okay, so the appendices are basically annexes. Let's take an example of GST refund applications. When you say GST refund applications, the application has to be made in form RFT01, right? Along with RFT01, you have to provide a certificate, chart accountant certificate, stating that the burden of proof has not, unjust enrichment was not taken. That means the credit has not been carried forward, passed on to the consumer. So that certificate is basically the appendices, and the RFT01 application form is basically ANF. Next one, we also talks about DCFT notifications, public notices, trade notices, and circulars. And the last one, customs notifications. You may have a doubt that while we are discussing about foreign trade policy, why this customs notifications has to come into play. It's very important because when the foreign trade policy says that the particular product can be exported or imported, when it comes to import and export, the customs act come into play. Okay, so the every provision that is available in foreign trade policy will have a mirroring provision, same and equal enabling provisions in the customs as well. Okay, so when the policy says that the particular goods can be imported, so the similar provisions should also be there in customs to allow the import of that particular item. So the customs provisions are equally relevant. So under this topic EPCG, what are the subtopics we are going to cover? The first one, eligibility. So who are eligible for getting EPCG license? Second one, what is the application procedure for getting the license? And after getting the license, how we can utilize the license, how we can import the goods using the license. Next, compliance in export obligation period. So this import, since the government is giving a duty exemption, the import will always come within conditions. So that how do we fulfill those conditions during this export obligation period? So usually they will give you a period of 6 years within which you have to fulfill certain conditions. So that we'll discuss in the next topics, next slides. So the last one, the redemption application. So once you fulfill all the conditions, so the last part is about redemption application. So you have to prove to the satisfaction of DGFT, the government. So basically, it's a department which governs foreign trade policy. So you have to prove to the DGFT that you have fulfilled all the conditions, so that you will ask them to issue a discharge certificate. We also call them as export obligation discharge certificate. So first talk about eligibility. So who are eligible for importing capital assets without paying any customs duty under EPCG license? Okay. So the first part is about what is eligible to import. So the first, all capital goods are eligible for pre-production, production, and post-production. So when we talk about pre-production, let's say an example of you are manufacturing a agricultural vegetable oil. Let's say you're manufacturing vegetable oil. So when you get a vegetables from the farmers, you will have to do washing, cleaning, and also you will have to do let's say it's cutting, and also the sorting out which products are not damaged, which are damaged. So sorting also has to be done. So for these activities, if you are procuring any machinery, even though that doesn't have any relation with the production, so after pre-production, production will start. So even for these kind of transactions, you're still able to import capital assets under EPCG license without paying any customs duties. And production activity, and post-production. What are the activities that will cover under post-production? It's basically packing and labeling, stickering activities. Activities will come under post-production activities. So for these three categories, you are eligible to import capital assets. So what is capital asset? What are the items covered under capital goods? So capital goods has defined under Chapter 11. So it was defined under Chapter 11, which includes plant, machinery, equipment, and accessories. It also includes accessories to the capital assets required for manufacture production. Okay, it could be a pre-production, production, or post-production, either directly or indirectly. These two words are very important. It could be directly involved in the production activity, or it could be indirectly involved. What is the example for indirectly involved? Is that, see, there are a few capital assets which are required to be imported along with a computer software through which the asset will run. Okay, to run certain machineries, you will need a software technology. So along with that, you will also import the computers with software embedded within the computer. Even though the computer will not form part of the production activity directly, it indirectly contribute to the production activity. So those assets also eligible for import under EPCG license. The second comes the very important point that, so who are eligible to import under EPCG is that who are manufacturing and exporting goods, and also who are exporting services. Okay, so many of the exporter doesn't know about this doesn't know that the EPCG is still eligible for the service exports also. Okay, so yes, yeah, even for the service exports, the EPCG license is still available. But under services also, there are different categories. The first category is export of services across the border. You are exporting services out of India. Second category is you are providing services within India to the consumers of the countries outside India. Let's say the classic example for the second category is hotel and also the hospital industries. So let's say the foreign tourist has come to India and he has stayed in a 5-star hotel. Okay, so for the stay he will pay it in foreign currency. So even though the services are not exactly exported out of India, under foreign trade policy, for the sake of foreign trade policy, to get the benefits under FTP, this is also be considered as a export. So let's take another example, that the foreign patient has come to India and joined the Indian hospital and took a treatment for almost a month. And for this treatment, let's say he has paid it in the foreign currency. That this also be considered as export for the purpose of FTP. So these hospitals and hotel industries also eligible for EPCG license. So there are few categories of goods which are covered under negative list. So these items are not eligible to be imported under EPCG license. So that was given Appendix 5F. So these are basically the items of furniture. Let's see, furniture items are form part of the office, which doesn't have any role in manufacturing activity, right? So these furniture and equipments, and also the computers used in the office, and also the second-hand machineries, those are not eligible to be imported under EPCG license. If you want the full list of the items, you will have to refer Appendix 5F. So yeah, so who can import and export under EPCG? The first category is manufacturer exporter, with or without supporting manufacturers. So let's understand the who are manufacturer exporters, who are supporting manufacturers, and who are merchant exporters. So manufacturing exporters are basically the exporters who manufactures the goods by themselves and exports the goods. Okay, and who are the supporting manufacturers? Supporting manufacturers come into play when you don't have sufficient manufacturing capabilities. Then you will send your materials to other manufacturing units, and you will get the goods manufactured there, and you will receive the goods back. Let's say job workers. Okay, so these are the supporting manufacturers. And third category is merchant exporters. So merchant exporters doesn't do any manufacturing activity. They will only engage in trading activity. Okay, but they will tie up with the supporting manufacturers, job workers. So here, the EPCG license can be applied by either manufacturer exporters or manufacturer exporters with supporting manufacturers. That means he can import the machinery under his name, and he can install the machinery in the premises of supporting manufacturers, where the job work activity can happen. And third category, the machinery can imported by merchant exporters, and he can install this machinery in the premises of supporting manufacturers. So all three categories are allowed to import under import machineries under EPCG. So service providers, as we already discussed. So the import of capital goods is subject to actual user condition. Okay, so when you're importing a capital asset without duty, the primary condition is that only you should use for manufacturing activity. Okay, so this has a few exceptions where exception that we already discussed in the above point is supporting manufacturers. You can import and send it to the supporting manufacturer premises for the manufacturing activity. And also you can do the intra-unit transfer. If you have a two manufacturing plants, one in Andhra, one in Tamil Nadu, so you can transfer from one unit to another unit. Yeah. So let's comes to the next comes the export obligation that we will discuss in the next slide. Okay. So the first activity is application for license. So what are the documents? What are the information you need for making an application for EPCG? The first one is application should be made in ANF 5A, and you should also have a IEC valid IEC code, import export license code, and also RCMC, registration income membership certificate. It's basically a membership from the Export Promotion Council. For each product, there is an Export Promotion Council. Let's take for engineering product, Engineering Export Promotion Council is there. For agriculture product, APEDA, Agriculture Product Export Promotion Council is there. For service exports, SC MC, Service Export Promotion Council, SCPC is there. So this membership certificate from the relevant Export Promotion Council is also required, and GC registration certificate. The next one, Nexus certificate. We also call chartered engineer certificate. So this Nexus is basically relation. Why this is important is that when you import a capital asset, okay, so you should provide in the application that using that capital asset, what are the goods you are going to manufacture. Okay, so and you also have to establish a nexus relation between the capital asset and the resultant product. Okay, so whatever the goods you are going to declare in the application, so that goods has to be manufactured and exported out of India. So past 3 years export turnover is also required to be certified by a chartered accountant. This is required. Why this is required, we will discuss. And machine write-up and process flow chart. So how this machinery works. So what activity it does in the manufacturing, and how the product will flow from one stage to another stage using this capital asset. Those process flow chart is also required to be submitted. And tariff. What is the tariff code, HSN code of the imported product, and also you have to submit a duty computation. So what are the duties applicable to the relevant machinery that has to be computed and submitted along with the application, which includes basic customs duty, social welfare surcharge, and agriculture infrastructure and development cess, and IGST and compensation cess. And one important point we should remember is that anti-dumping duty, ADD. The anti-dumping duty is not exempted under EPCG. When you're importing a capital asset which attracts ADD, anti-dumping duty, that has to be paid. Next one. We also have to give tariff HSN codes for the export items, and also you have to give the port of import where you're going to import the machinery. So once the application is made, the application will be processed with, in the DGFT, and they will sanction your license. And when you, after issuing a license, when you notice that there are certain particulars that needs to be amended or changed, so you can make an application for amendment of license with a revised chartered engineer certificate or nexus certificate. That is about application for license. So what are the conditions attached to the license? When you apply for a license and when you're getting a benefit of duty exemption, that will comes with the conditions attached to it. So what are the conditions? So the license is valid only for the 24 months from the date of authorization. When the license is issued from, let's say on 1st April 2022, so you can import this machinery and using the license only up to 31st March 2024. Within 24 months, you have to make an import. And you cannot extend the validity period further. So let's next condition is that export obligation. This is basically, when you import and when you, let's say you have shaved 1 lakh of duty, so you have to make exports of 6 lakhs. This is basically 6 times of duty saved. You have to make an export value which is equal to 6 times of duty saved. So you have to make export turnover of 6 lakhs in the coming over 6 years. So when you are saving a 1 lakh rupee of duty, you have to export goods worth 6 lakhs over next 6 years. So that is the condition. That we also call as specific export obligation. Again, the export obligation, there are two types. One is specific export obligation and average export obligation. Specific export obligation is equal to 6 times of duty saved that has to be fulfilled over next 6 years. And what is the average export obligation? Earlier, I told that we have to submit a chartered accountant certificate certifying export turnover of last 3 years, right? So that last 3 years export turnover, they will average it, and that export turnover you have to keep maintain over the next 6 years, over the next licensing years. That specific export obligation has to be fulfilled over and above the average export obligation. This makes sense because when the government is giving you a new machinery and you are basically adding new capacity to your plant, okay, so what government expects is that along with the regular production capacity which you are maintaining, that has to be maintained even now also. Apart from that, over and above, you have to fulfill 6 times of duty saved, which is a specific export obligation. That means you have to maintain the average of last 3 years export turnover, plus you have to additionally make a 6 times of duty saved amount as an additional export turnover. So these are basically specific export turnover and average export turnover. So this has to be maintained till next 6 years. 6 years is the licensing period, and if you are able to fulfill this specific export obligation next immediately 1 year or 2 years, that is also good, well and good. And if, let's say if you have taken 2 years for the completing specific export obligation, for the next 2 years you should also have to maintain average export obligation. Yeah. So next one. So this export obligation period of 6 years can be extended further. Let's say due to some unforeseen scenarios, let's say your export contract got cancelled. That time, basically you may fail to discharge this export obligation within time. That time you can approach DCFT and make an application to extend the export obligation period to further 2 years. They will give you 2 extensions each year for each extension. They will extend you for 2 more years. So that means totally in 8 years you will have to fulfill specific export obligation. So this extension comes with the application fee of 10,000 rupees. Okay, so now we have got the license. You have imported the machinery using the license. Okay, I mean, sorry, you have got the license from DGFT, and the machinery has reached to the port. Okay, now you have to use this license to import this machinery. Okay, so what procedure you are going to follow? This we also call as utilization of license. You are using this license to import the machinery without paying duty. The first step, what you should do is you should submit a bank guarantee to the customs. So here you are importing goods without paying duty, with a condition that, with a promise to the government that you will fulfill these conditions. Okay, the government doesn't want to blindly trust you. So basically it will ask you to produce a bank guarantee. You submit a bank guarantee that you will fulfill all these conditions. So this bank guarantee is important to use the license. But considering the difficulties faced by the taxpayers, the importers, the government has given one relaxation. If the exporter is making 1 crore of exports in the last financial year, or if he has paid 1 crore of GST in the preceding financial year, is eligible for waiver of bank guarantee. So he is not required to submit a bank guarantee. Instead, he can produce a CS certificate certifying the previous year export turnover or GST amount. So this is the benefit given to the importers. And let's say you have got the license, and you don't want to import the machinery. That time you can surrender the license. You can surrender the license at any time, and there will be no cost and no penalty. Okay, so there's one more practical scenario where, let's say you will apply the license now, and for getting the license it may take 1 week or 15 days maximum, and after 15 days you will get the license and you will go to the customs, you will register the license and you try to import machinery. That time, so the foreign exchange rate available at the time of application will vary to the exchange rate which is available on date of import. Okay, there will be foreign exchange fluctuations. That time, the duties saved which you have computed at the time of application will slightly differ. Okay, so this difficulties, due to this difficulty, the customs department refused to clear the machineries. So this has been identified by the government and issued relaxation, issued clarification saying that if this difference amount is below 10%, then the customs authorities can clear the machineries. But if this for the differential amount, see the EPCG, while making an application for EPCG, you will have to pay application fee. So when this application fee basically depends upon the duty saved amount. So this 5% or 6% is getting increased at the time of import. The proportionate fee also has to be paid at the time of redemption, as well as the proportionate export obligation also will get increased. Okay, this is about utilization of license, import of license using EPCG license, import of machinery using EPCG license. So the next part is about, okay, so till now what you have done, you have made an application for EPCG license, you got the license, you have registered in the customs port, and then using the license you have imported the machinery. Now after importing the machinery, still there are cases, we have seen many cases where the importers only concentrated on import activity, okay, post import. So they mainly focused on importing the machinery without paying duty. Once the machinery is cleared without paying any duty, okay, they'll forget about the other conditions which they have to fulfill during the export obligation period. So we already discussed about the conditions to be fulfilled that has to be happen for the next 6 years. Otherwise, the benefit which the government has given at the time of import will has to be paid back along with the interest and penalty. So as much as we import machinery without paying duty, it's also important that you have fulfilled all these conditions during this export obligation period. So what are the compliance you have to make during this export obligation period? The first one is the first activity that you should do after import is that you should submit an installation certificate certified by a chartered engineer that the capital machineries have been imported and installed in the premises of the importer or premises of the supporting manufacturer. So this certificate has to be submitted. Otherwise, if within 6 months, if you are not submitted within 6 months, there is a composition fee of 5,000 rupees that has to be paid. So these insurance certificates also plays a critical role when you make an application for redemption of license. The redemption we will discuss in the next slide. Okay, so the next one is, okay, so as we discussed that 6 terms of duty has to be full. I mean, as we met by way of exporting these goods. Okay, so when you make an export, you will file a shipping bill, right? So in this shipping bill, you will have to declare the details of EPCG license. Okay, only then that relevant shipping bill will be considered for redemption of the license. Basically, redemption comes after you fulfill the export obligation. Okay, you will prove to the DGFT that I have fulfilled all the export obligations. That we call as redemption procedure. So once the DGFT is satisfied that we have fulfilled the conditions, they will issue a discharge certificate saying that you have fulfilled and you are no longer liable for any penal actions. So that for redemption procedure, this shipping bill having the license details is very, very relevant. Otherwise, there may be cases the DGFT may not agree that you fulfilled the export obligation. Next one, if you are goods using supporting manufacturer, then supporting manufacturer details also has to be declared on the export documents, such as a shipping bill. Let's say you are importing a machinery, okay, and you don't have direct exports, because you don't have any contracts in the overseas countries, but you know a party where who does an export. Okay, then what you will do, you will manufacture the goods and you will give it to a third party, and third party will in turn export. Okay, it's this we also call as third party exports. So even these third party exports also will be counted as a export obligation export obligation for the purpose of redemption of EPCG license. So the export need not be through direct exports, it can also be a third party exports. Even you can directly export, or you can give it to the third party and third party can export. These two also will be counted as export turnover for fulfillment of export obligation. Okay, so next one. So when you export these goods through a third party, so the important point you should remember is that the third party details and the licensee holder details both has to be declared on the shipping bill. And the exports which you are going to make through advance authorization, duty-free import authorization, duty drawback, and RODTEP and ROSCL, these turnover also will be counted towards EPCG export turnover fulfillment. Okay, so the next one, this need not be a physical export. There are two kinds of export: physical export and also deemed export. Supply the export of goods out of India is a physical export, and also under FTP, if you supply goods to SEZ, it will also be counted as a physical exports, because under FTP, SEZ will be treated as a outside India. And also second category is deemed export. Deemed export is basically supplied to EOU. So EOUs are mainly are within India. Okay, they are not foreign territories, but these EOUs are located within India. And when you supply goods, these EOUs who are located within India, these are also be counted as an export obligation fulfillment. Okay, and the final point is, let's say I will give you one practical example. You have two units, one in SEZ and one in DTA. DTA is basically domestic tariff area. It's within India. Then when you make an exports both from DTA and SEZ, okay, the export turnover which you have made in DTA only will be considered for the fulfillment of export obligation, because the status like SEZ and EOU will be given only for 100% exports, to promote exports. Okay, that will not be counted as fulfillment of export turnover for the purpose of EPCG. The turnover which you are going to make only from DTA unit will be counted as export obligation fulfillment. Next one. So this export obligation, I mean, when you make an export, all the export process should be realized in Indian, it should be realized in a foreign currency, freely convertible foreign currency, or it can also be realized in Indian rupees, which was, recent amendment the government has brought, but this should be realized in a special Vostro account. And only in case of deemed exports, these proceeds can be realized in INR. Okay, so when we say that the export obligation has to be fulfilled in the next 6 years, okay, so there are two blocks also. The government has given that you should fulfill this export turnover in two blocks. First block is for first 4 years. Within first 4 years, you should mandatorily fulfill 50% of export obligation. In the previous example, our export obligation is 6 lakhs. 6 times of duty saved, which is 1 lakh. 1 lakh of 6 times 6 lakhs. So first 3 lakhs of export obligation will be fulfilled within 4 years. The balance can be fulfilled in the next 5th and 6th year. And this fulfillment, block-wise fulfillment also has to be intimated to DGFT. Otherwise the penalty of 5,000 will be levied. So there's an option to, the government will give you an incentive for early fulfillment. Let's say you have fulfilled 75% of the export obligation within first 3 years or first 2 years. Okay, less than or equal to half of the export obligation period, which is 3 years. Then remaining 25% of the export obligation is need not to be fulfilled. So this is given to accelerate the exports, to improve quick exports. And also in case of green technology products, the government has given the benefit of saying that you don't have to fulfill 100% of export obligation. You can only fulfill 75% of the export obligation. Green items like solar energy and wind energy items, devices. So here we comes for the final part, to the final part called redemption procedure. So once you fulfill all the conditions, okay, the story will not end there, and many of the exporters, leave the matter there. But the final part is very important part is redemption application. You should prove to the DGFT that you have fulfilled the export obligation. For this, you have to make an application to DGFT, and also you should fulfill the proof of fulfillment of export obligation. That is basically shipping bill copies, and also export invoice copies, and also EBRC. It's a bank realization certificate, which shows that you have received foreign currency for the exports you have made during the past few years, licensing years. And one more point that we should remember, that while, as I already told you, that while maintaining, while fulfilling a specific export obligation, which is 6 times of duty saved in next 6 years, you should also maintain the average export obligation for each licensing year, right? So let's say in 1 year you have no business, you have not done any exports, then there will be a shortfall in average export obligation. So in that cases also there is a relaxation, that shortfall can be fulfilled in the coming years. Let's say in the third year you have not done any exports, the exports is zero, but in the fourth year you have done twice the exports, then this shortfall can be compensated with the excess exports you have made in next year. Okay, so let's say that you have not fulfilled the export obligation within the licensing period of 6 years, or extended period of 2 years. Totally in 8 years, you have not fulfilled it. You have not done any exports. Then what will happen? That the government will ask you to pay the customs duty which you have got as exemption at the time of import, along with interest, tax, penalty. Okay, that customs duty has to be paid along with interest and penalty. So that is the reason that the redemption application is very important. So let's take an example of how do we fulfill an export obligation. So with this, I think we are concluding this topic. Uh, the example here is that we have an export turnover in the year 21, 22, 22, 23, and 23, 24 of 10 crores, 20 crores, and 40 crores. And we are going to apply a license on 12th April 2024. In the next year, in year 2024-25, we are applying a license. And as part of application, we also have to submit last 3 years export turnover. So we will submit 10, 20, and 40. So while fixing average export obligation, the DGFT will take average of these three exports. So the average export obligation is 20 crores, 10, 20, 30, and 70. Let's say it's 30, 10, 20, and 30. Then total is 60. 60 divided by 3 years, its average is 20 crores. And specific export obligation is 6 times of duty saved. Let's say duty saved amount is 5 crores, and 6 times of duty saved is 30 crores. So along with maintaining average export obligation of 20 crores on each and every year, you should also fulfill specific export obligation of 30 crores over the next 6 years. Okay, so so in the first licensing year, let's say we have made 20, and next year 25, 10, 10, 40, and 40. Okay, so one crucial point here is that while measuring export obligation, first you should apportion the export turnover towards average export obligation. Only the turnover over and above export obligation, that should be counted towards a specific export obligation. So first you should set aside turnover for average export obligation, and remaining turnover should be used for the specific export obligation. Here first year the export turnover is 20 crores, but the average is only 20 crores. So fully used for the average export obligation. Specific export obligation is zero. So the balance export that we have to fulfill is 30 crores. Coming to next year, the total export turnover is 25 crores. So first 20 crores should be taken out for the purpose of average export obligation. So remaining we have 5 crores of turnover that will be counted towards specific export obligation. So the remaining specific export obligation is 25 crores. And the next year we have made only 10 crores. So there is a shortfall in the average export obligation. And the next year also there is a shortfall in average export obligation. In each year we have a shortfall of 20 crores in average export obligation. So uh, coming back to the second. Yeah. So specific export obligation we fulfill is 0. Still we count as 25. So 0, 25, and here so 25, 45, and 25. Yeah. So in third year and fourth year, there is a shortfall in the average export obligation. That means the shortfall can be compensated with next year excess average export turnover. Excess export turnover. So in the fifth year, we have made 40 crores. Okay, so first 20 crores should be taken for the average export obligation in the current year, and there is a shortfall of 10 and 10 in the previous third and fourth year. That 20 crores can be compensated here, and we don't have any surplus turnover towards specific export obligation. And coming back to the last year, uh, here out of 45 crores we should take out 20 crores for the average export obligation. Remaining 25 crores we can use it for the specific export obligation. So specific export obligation becomes 0 here. So we have fulfilled both specific export obligation of 30 crores over the period of 6 years, and also we have fulfilled average export obligation of 20 crores in all 6 years put together. Okay, so using but here we have lost one condition here. What would be that? Anyone can highlight? So as we already discussed that there is a block wise fulfillment. Up to first in the first block, up to fourth year, we have to fulfill at least minimum of 50% of the export obligation, which is around how much? Uh, 30. I mean, it's only 25%. It's 20%, below 20%. Only fulfill only below 20% up to fourth year, but we are supposed to fulfill 50% of the export obligation. So then we will have to pay. So there is a shortfall in first block. Up to fourth year, we have a shortfall of 30%. So on 30%, we will have to pay duty along with interest and penalty. So let's slightly modify this example, where in the first year we have made 20 crores, and next year let's say we have made 30 crores. Then first we have to subtract 20 crores towards average, then remaining 10 crores. Then we'll have a specific export obligation of 20 crores. Let's say we have made here also 30 crores, and we will remove 20 crores towards average export obligation. We also have 10 crores, and we will remaining balance of 10 only. So there is shortfall here. 10, that 10 has to be fulfilled here, and excess we have of 10 again. So specific export obligation also got fulfilled, and average export obligation also fulfilled, and we have still have surplus turnover of 25 crores here. So if you see here, so in the first 4 years, first block we have fulfilled how much? Around 20. It's more than 50%. Okay, almost 75% we have fulfilled here, and remaining 10 crores we have fulfilled in the fifth year. So we have fulfilled specific export obligation of 30 crores, and also we have fulfilled average export obligation of 20 crores, and we have also fulfilled the block wise export obligation fulfillment. So this is about computation of specific and average export obligation. I think we have gone too fast considering the time limit. So if you have any doubts in this, can unmute and then ask the questions. I think with this we are over with the presentation. If anyone have any doubts, can unmute and speak. Yeah, I think somebody has put it 50% obligation. Yes. Anyone has any doubts? This is about EPCG where you can import only capital assets, and there is another scheme called advanced authorization where you can import raw materials for manufacturing and then export the resultant product. If next goods to outside India, where you can save import duties on imported raw materials. Maybe that will we will cover in the next sessions to come. Anyone is having any doubts? Can put in the chat box, or we can wind up the session. Okay, so thank you everyone. So we can, I think we can wind up the session. Thank you everyone.